The S&P 500 stock market index made a new high on the last trading day. And so in this video, we will analyze the unusual options activity of market indexes to understand how the wealthy investors are positioning themselves so that we can learn how to trade to make sure that we also make money while they are getting rich and richer on Wall Street. So without further ado, let's get to the analysis of these unusual options. So to do so, we will take a look at the SPY ETF that tracks the S&P 500 index. So for the options being traded on the last trading day, March 8th, we can see here that there was very significant trades happening that were at least 100,000 contracts, as you can see here. These were being traded by the same trader because you can see the time that it was being done at 10:34 at the 42-second mark. We can also see that just a few seconds later at the 51-second mark, these same trades also came in. And so these are most likely the same trader being just a few seconds apart. Okay, so we will analyze what this means here for these April 26 options at the 425 strike puts, 450 strike puts, and the 400 strike puts. We will also take a look at this trade that happened 20 minutes before at 10:14 as well. Okay, this was right here for these 49,000 contracts expiring March 22. So this is more near term in the shorter term. So we understand what they are doing in the shorter term. Okay, so let's get to the first one, April 26. We can see here 400 strike puts, volume of 150,000 contracts. 425 strike puts, 300,000 contracts. 450 strike puts, 150,000 contracts. So what are they doing here? For each of these trades, what they are doing is they are selling the 425 strike puts, 2 of them for each trade, and then buying one of the 400 strike puts and buying one of the 450 strike puts. And so when you analyze this trade, you can see what this is. This is a butterfly hedge, because you can see that currently we're trading at 511 here, right here. The x-axis is the price of this ETF, and you can see that this profit loss diagram here, where on the y-axis shows profit, if the lines are above the 0, this is profit. If it's below a negative here, that's a loss. So you can see that if the market goes down, profit actually increases, right, to a potential maximum profit of $2,472 at expiration, April 26. So that's essentially turning $17 into $2,472. Okay, so that's a tremendous amount of gains there. Okay, you can see an estimation of that, about 2,400 divided by the initial investment of 17 times 100. You can see that this is 14,000% increase for these very, very cheap butterfly hedges, essentially hedging the market, that if it drops and crashes down to the 400 level, between 400 to 450. If it hits around 425, that's a 14,000% gain here. So this is how this wealthy investor is positioning themselves to make sure that if the market crashes down, all the way down, that they do not lose money, because these hedges will turn their profits to essentially turn all those potential losses that they had in their long bullish trades on other stocks they may have, turning it into a gain now, because you can see how much percent they could increase from these very cheap hedges. So this is a good idea on how one could hedge their portfolio in case the market crashes, okay? Because you don't need very many of these cheap hedges to do that, okay? So it's something we can learn on how the wealthy investors are positioning themselves. And that's what we do. We look at what wealthy investors are doing so that we can set up strategies and learn from what they are doing, because we know they have a lot more capital to put into the financial research to find out how to trade effectively in the markets to continue to stay profitable. All right. So if you want to learn more on how we analyze their trades and what they are trading, go to our website. We'll put a link at the top here. All right. So what else are they doing? So if we take a look at these other trades over here, for the trades down here that expire March 22 in the shorter term, 49,000. What exactly is going on here? Let's take a look. So March 22s. So shorter term in just 12 days. You can see here what they were doing here, okay? 515 strike calls, okay? 100,000 open interest. What they're doing is taking profits and rolling to a higher strike price. They're closing out of this trade, moving it to the 520. You can see here there was a total of 61,000, much greater than the open interest here. Okay. And also, not only that, there was two other strike prices here. For 525, they were closing out of this one as well and moving to a higher strike price over here. You can see 52,000 volume greater than the open interest at the 530. Okay. So their opening trades is actually the 520, buying the 520 and selling the 530. And so this is a vertical call spread here that is bullish. You can see this right here. We know this is bullish because you can see again, if the market goes up, profit goes up. If market goes down, it is a loss, a negative here. Okay, so this graph takes into account the initial cost of this trade already. Okay, and we can see from the Greeks, this is a bullish trade because the delta is positive. If it was a short position, it would have been a negative delta here. Okay, so we can see that overall here, what they have essentially did was take profits and continue to stay bullish. Because notice that at the time when they did this trade at 10:14 22nd mark, the market was actually trading at 5:18. Okay, you can see that. And so their 5:15 strike calls were in the money. Okay, because that's below the 5:18. So they were in the money with these calls. They took profits, okay, on their previous trade, which was also a vertical call at the 5:15 and the 5:25. So they essentially moved their strike prices up this vertical call spread to a higher strike price. So they're staying bullish on the trade. Okay. So that is their new position, the 520 and the 530s. And you can see the risk to reward ratio here of 155 risking per trade they can potentially make. You can see $845 at max profit. So you can see here that again, this 845, we divide by 155 to see the risk to reward ratio here. This is a 545% potential increase here. So this is how we also set up our option strategies. We always want to make sure our reward, the potential profits, is a lot more than what we could potentially lose. And that is how we stay consistently profitable overall, because it's not a matter of how much you lose or how much you win. It's, can you make more when you do win, and do you lose less when you do lose? That is the key in being profitable in the stock market and how we can beat the market. And we have found that wealthy investors trade in a way where the rewards are very favorable against their risk. And so that is what we do. All right. Again, go to our website if you want to learn more. On top of that, because we are trading the same trades the wealthy investors are trading, we also increase our probabilities of profit. Comment below on what you think about the strategy that makes 14,000% profit if the market crashes. Please smash the like button, subscribe if you haven't, and have a great day.